Hello, ladies and gentlemen. It's ibmtv investment show with Sasha, and I would like to introduce my guests. It's a very successful investor, multi-billion dollars fund manager, Shaquille Latimer. Hello, Shaquille. Welcome to the show.
Good afternoon.
Bill Trevisant, our special representatives in Washington, D.C. Hello, Bill. How are you?
Hello, everyone. How are you?
Okay, very well. So let's talk about investment trends and what's happening. I've noticed in one article that there is a great proliferation in the United States. The so-called small investments, primarily run through Robinhood investment house. They allow no commission investing, and their average account size, believe it or not, is $4,000. Of course, there's a lot of probably much bigger accounts than that, but with $4,000, I'm really curious how they can successfully operate with this small amount. Shaquille, do you have any thoughts on that?
About how they're successfully operating? I'm not sure. They might be selling other products. I don't know a lot about Robinhood, actually. But look, I mean, anything that helps people get into the market and you know, in this environment, you're trying to sort of save some money or something, and you know, where do you put it? The banks are not offering you very much. You know, people might want to put a little bit of their savings into something like this, and it's probably a good way for them to get exposure. But yeah, look, I think broking in general and trying to make money from executing people's trades for them is becoming a very, very difficult business with very thin margins. So I'm not sure how they're doing it.
What are your thoughts, Bill?
Well, actually, I had a question for Shaquille. I mean, do you think that they would be trading just for the sake of trading, so that they can pick up the transaction fees, or do you think they'd be trading to increase the value of the individual portfolio?
To be honest with you, I don't know enough about Robinhood to tell you. I just don't know what their model is.
I'm not specifically talking necessarily about Robinhood, but a hypothetical firm that was building accounts at 4,000. Because it seems to me that in a market with very tight margins, that 4,000, I'm just not sure about that. And I guess our independent investors out there would wonder about that too.
Yeah, look, again, I think it would be very hard because, look, you know, back when I was a dealer, back when I was on the dealing desk, you know, we would charge fees that, you know, would be outrageous today, you know, $100 per futures contract per side and things like that. Like, it was just, you know, you could never do that today. But we were phone brokers, you know, so somebody would ring us and say, we want to do 10 contracts. And, you know, as a dealer, that you're going to, you know, make probably half of the commission. So, you know, you might make $1,000 just for the day, just from that one client. You can't do that anymore. And now I think that the model is more, you know, you've got salespeople on, and you know, they'll try and entice people to open up an account, but you know, they might get a small percentage off the overall brokerage that's been paid. But the margins are so thin. I think what you need is a large number of clients. So if you've got, you know, 1 million people on your books that place one trade a month, and you make, you know, $1 per trade, well, you're going to make $1 million a month. But you know, you really have to have those large numbers, and that's why I think you're actually seeing a lot of consolidation, or you've already seen a lot of consolidation in the broking industry, because the smaller brokers have sort of all been bought out by bigger and bigger guys, and you just have these handful of really big mega brokers.
So my take is though that First of all, they're offering commission-free trading. So supposedly they're not making any money on your trade. Let's say you put order to sell. Actually, you cannot sell anything with $4,000 on your account. And I'm talking about primarily option tradings because a lot of these people are trading options. Now, I would assume that with $4,000, you cannot sell any options. You can only buy options, and by all statistics available, it's a losing proposition. If you're buying calls or puts, you have to be not only right on the direction, you have to also be immediately right, because even if you will be eventually right, maybe say a few weeks, a couple of months, the time will eat any money, whatever you put into the contract. So it's very, very difficult. You have to be really right on the dot. And a lot of these people, they're trading, they're buying calls or puts. Let's see, today is Wednesday, so they would buy options which expiring this coming Friday, for example, right? So you have to be right on the money, and if you're right, you can make pretty good money. So, but the problem is that even if you make good money, say one time, two times, five times, on a sixth and seventh time, you probably would lose. I would be surprised if it's otherwise, and it's a very, very tough proposition. As commissions concerned, I think they're selling the flow of orders to bigger brokerages and getting compensated by them for execution of trades. I would assume that is probably the truth. But from individual point of investors, it's in my opinion, it's a tough proposition unless you're buying some inexpensive stocks, and if you're right, they can rise in value. But what I read is that mostly the small accounts, they are actually trading options. And trade options, actually the volume, Shaquille, as you know probably, that there is a huge increase in trading options these days. And I'm not suggesting that Robinhood, with this even millions of small $4,000 account, can affect the volume of option trading. So I think the big boys also trading a lot of options. And if you look at the trading reports of Goldman Sachs, they are deriving a huge amount of profits from their trading.
Mm-hmm.
So I would assume that these people are making tons of money, not just $4,000 individual accounts.
Probably right about order flow. That's probably a big part of it, and also on smaller accounts. When they say the average is 4,000, I mean that doesn't mean that they're all 4,000. There might be a few that are smaller. People are just starting out a few hundred. There could be some people that've got really large accounts. I'd say they're probably making some money from the interest that's not very high right now, but the interest on the money that they've got in their trustee account or their, whatever it is, the client's account. And they possibly could be rehypothecating positions that are in the account, or essentially they can be loaning out stock that they're holding in their custody account for their clients and receiving a stockbroker fee. That's what a lot of the ETFs do. That's why you see such low fees on the ETFs. But look, it's not a business that I would... I wouldn't sort of want to start up a fee-free brokerage right now. I think that there's such a rush to the bottom already. So,
well, so then do you think that the firms are just operating as a feeder system, as you suggested, Sasha? That is to say that they're essentially, I mean, because if they are, could it be that their goal is to grab the data and then sell the data on the to other customers, and that's where they could be making?
Very possible. Yeah, that's very possible. You know what? I wouldn't mind to consider this as a proposition for people with a small bankroll to get involved in the market and learn something from that, and only then invest in maybe larger amounts, right?
Okay.
So maybe that's how it would ideally work, because the proposition of $4,000 account, it's quite scary to me.
Okay, but Sasha, what advice would you give them? I mean, if in terms of as they go along with 4,000, what kind of growth should they expect, so that they know that they're headed in the right direction, because the market is volatile? And then when should they consider, how long would the horizon be? And then when would they consider moving off to a larger kind of investment strategy?
Okay, from what I'm trying to say in the last several sessions of investing here on ibmtv, I'm suggesting that number one rule is preservation of capital. Number two, I'm of the opinion that on individual accounts, preposition of buying options, calls and puts, it's most of the times losing preposition according to statistics available at this time. Selling options, on the other hand, which is profitable strategy, but it's unattainable with a $4,000 account. So if I were, let's see if my bankroll would be, say, $500,000, and I never traded the market, and I would open Robinhood just to test the waters to see how it works or so on. So if you cannot buy options because of what I said before, and you cannot sell options as well, so you're stuck with basically buying some shares, and with $4,000 you can buy one share of Amazon, probably. That's all what you can do. And or about buying shares of Microsoft if you get them. So you buy probably 20 shares of Microsoft. Okay, so then
Couldn't they buy into a fund, an index fund, with $4,000?
absolutely, you can buy index funds, you can buy different ETFs and so on. It's a more conservative strategy, but again, your return will not be that great. With index fund, maybe you can, if you're lucky, maybe you can get from 10 to 15% annual return, and that's not so bad. So at least
It
if
does depend on the market a little bit, but you might, if you're trying to trade options with a relatively small account, it is an advantage you're not having to pay brokerage, because when you've got minimum ticket fees, that can eat into the profits that you would otherwise make, especially when you're first starting out and sort of trying to learn. But yeah, if you've got a sort of $4,000 or $5,000 account or something like that, you could actually get some exposure to spread trades, Sasha, like we've talked about before, where they buy a call and then sell a call against it, a bull call spread, or bear call spreads, bull put, bear puts, those sorts of things, because there's limited risk there. So that would be something that somebody could do.
Yeah, well, I don't think that people who are new to the market would start doing the spreads, whether call spreads or put spreads or anything like this. I doubt that. It's possible, but you're right. It's available, it's there, and if people would figure out how to do that, at least it would get their feet wet, and maybe then they would go to a larger amount, and they will gain their confidence to trade larger amounts, and maybe that's the case. So I would. I'm not trying to discourage people from doing this type of strategy, but again, if they can think about preservation of capital as a first goal, and therefore be very diligent in the trades what they're putting in. Yeah, maybe that's a good way to start their exposure to the market. If it's commission free, that's another advantage. And listen, we are talking about an average account of $4,000. So there may be some people who open an account with $1,000. On the other hand, maybe there are some people opening with $20,000. They have a pretty good fighting chance if they're not putting $20,000 in one trade, but they will start with the small, like you said, spreads here and there, and build their confidence. I think it's quite encouraging.
And Cecile, what would you suggest to people in the same financial range, anywhere from $5,000 to $10,000, or the under $10,000 investors? What would you suggest?
I think that they've already got a reasonable handle on shares themselves, which I think a lot of people do before they get to options. I would say to probably learn the spreads, because the spreads they're a lot easier to kind of understand once you wrap your head around buying and selling the options themselves. They're a lot easier to understand, and you can break it down and say, okay, the diamonds right now are at $285 a share. We are betting that it will be above 290, or it'll be above 280 between now and next Friday. We're risking $5 to make $5, so we're doubling our money if we get it right. and we're losing everything if we get it wrong, or potentially losing everything if we get it wrong. So if we're risking $5, I've got a I've got a $10,000 account. Maybe I'm prepared to just risk $500 on that trade. And then, hey, if I get the trade correct, I've made $500. So with a small account, brokerage does become a really big deal because, as I said before, if you've got a larger account, you know that you're going to trade, like in Australia, some of the bigger brokers here, if you trade less than $10,000, you're still going to pay the brokerage that you would pay on a $10,000 trade. So if you only trade $1,000, you're paying 10 times the amount of brokerage. It means that you need a much bigger move in order to break even on your position. But if there's no brokerage at all, well, hey, that can be a pretty good deal. And for somebody who's just starting out doing a spread trade, if it's the very first time you've done one, if there's no brokerage at all, why not just risk $100 and just see, whether that's something that works.
Yeah, I totally agree with you, Shaquille. I think it's a very prudent strategy. And so people with a small account, basically, it doesn't matter, it's $5,000, $10,000. I think the first few transactions, I would just stick to either well-known stocks, such as Microsoft, such as, NVIDIA is a different animal. Say Microsoft probably would be good. Well, Apple is unveiling this iPhone 12 product, so maybe their shares will probably move higher a little bit. So just be very selective, very conservative. Don't try to put a lot of money. Say each trade you should put maybe at risk. Ideally, no more than 20% of your bankroll. 10% would be even better. But because of its small account, I think the 20% probably could be justified, but not right away. I would still first few trades be very conservative, just to even learn transactional things, like there are always bid and ask spread. So you have to navigate how to put your order, how it's been executed. There are a lot of things to learn before you start to really to gain confidence, and then you will go to spreads and other things. So I think that it will require probably 6 months to learn and become a more confident trader. And in 6 months, if you didn't lose your bankroll, $4,000, $5,000, $10,000 even, if you're still there, you've done some trades, maybe you can increase your bank account. And then you're in the game. You start to do something meaningful.
When I trade my own account, my own personal account, I tend to not go anything over 10%. Most of my trades are 5% of my account. Certainly, when it comes to the professional stuff I do, I'd say that most of my trades would be less than 1% of my account. Certainly, at most, I'm not going to go above 2%. Unless it's a really good reason for it. That's on risk. But what I'll say with smaller accounts is, if it's say a $10,000 account and you risk 5%, you risk $500. If you can afford to replace that $500, no problems. That's just the cost of your education. If you can't afford to lose that $500, then don't do it. Go down and just risk 1% or 2% or something like that. Trade a few different positions at the same time, but don't overload yourself. So maybe do 3 or 4 companies. Look for the blue chip companies, look for big market caps. Something like GE at the moment is a dangerous play because they've fallen so much. So even though it's a household name, everyone's heard of GE, I'll probably stay away from them and focus on those big companies that Coca-Cola, McDonald's, all those sorts of big companies, Disney, Nvidia, Microsoft, Apple. The big ones have got big market caps. They're very valuable companies, and they tend to be a little bit more stable. Sorry, yeah. Bill, we say something?
Oh no, I was simply going to ask, when you place an order of maybe 1% or at most 2%. That's for just any single trade. But do you have multiple trades going on so that you have 2% here and 2% there and 2% there? Is that how you operate?
Yeah. So I would normally have quite a lot of positions on. And I try not to lever my account more than 100%. So, if I've got, obviously I've got a lot more than this, but if I've got $100,000 in my account, I tend not to have more than sort of 200,000 in positions. However, that may get higher than that. I will sometimes exceed that. But basically, I'm looking at it from a purely risk capital amount rather than the notional value of my positions. So how much am I actually risking per trade? And then I can go, okay, well, I'm only prepared to risk, 1% or 0.5% or whatever it might be. So the big thing to remember, if you lose 5% of your account, in order to get that back, you've got to make about a 6% return. But if you lose 50% of your account, you have to double your account. You have to make a 100% return just to break even. Mm-hmm. So, position sizing is really important. I think a lot of new traders tend to get that wrong. They tend to either take positions that are too big, or if they don't do it right at the beginning, they'll have a few wins and they'll think, hey, you know what, this is really easy. This is great. I should probably put some more money in. And when they start putting more money in, one or two things will go wrong. One, it'll go wrong, they lose it straight away and they sort of get a bit more cautious. Or two, what will really go wrong is if they actually make money on the trade. Because if they make money on the trade when they took more risks than they should have, then all of a sudden they go, well, that was really good. I made even more profit than I should. I've risked 50% of my account. I made this great return. Let me do that again. And eventually they're going to end up running into problems. So that's why it's so important, of course, is all the professional guys, all the hedge funds, the big dealing desks at banks, all those guys will be very, very cautious about position sizing, because it's as important as getting the trades correct.
Yeah, sorry, Bill. See, the problem, what you just described, obviously it's a basic investment strategy to be diversified, and therefore you don't put more than 1-2% in one trade. See, this is very, very difficult for a small account, because if you have, say, $5,000 in your account, 1% is only $50. There is not much that I'm aware of you can do with $50, or even $100 if you put 2%, right? Ideally, I have a fairly large account, but I never have more than 10 positions at the same time, because with 10 positions, it's easily managed. You can oversee all those positions. You can do adjustments if needed at any time. Actually, I don't trade a lot because I'm doing a lot of options and so on. So I do some adjustments. For example, if I'm winning on an option trade, let's see if it's not a spread, it's just a single option. For example, I'm winning on that. So I tend to cash in and get a further expiration time on that particular option, because now I can see that I'm on the right track and the stock is moving the way I thought it would. So I would first of all, I would get fixation on the profit, and I would continue that trade, but have a different more months of expiration, so it give me even more premium, and I'm still in a position. So for smaller account, I was thinking about how about if they would select 3-4 stocks in different sectors, say one high tech, say Microsoft, for example, one in retail, say Costco, like this stock quite a bit, and it moved up recently. So say Costco, and they're all huge tradable stocks. There are like millions of shares are traded every single day. So it's easy way in and out. There are no much spreads between bid and ask. So that's probably, then maybe one pharmaceutical company, like take, say, I think Pfizer at this time looks like pretty good stock, because first of all, it's an expensive stock. Second of all, it's one of the premier stocks in the pharmaceuticals. And then maybe another sector, maybe banks like Goldman Sachs. It's a little bit expensive, so go to Bank of America, or maybe you can go to Wells Fargo. I don't like Wells Fargo myself, but a lot of people trade Wells Fargo and probably make money, or Citigroup for that matter. And just concentrate on this 4, maybe 5 stocks. I wouldn't recommend more than 5 stocks for that. What do you think? Is that making sense?
Oh, no, sure, it's making sense. But I had a question for you, Sasha.
Yeah.
That is that perhaps our audience and the whole world has really been hearing about this movement to sustainability stocks in the environmental or the technology area. How do you feel? Because if you're a small investor and those are perhaps startup companies and their stock is relatively cheap, how do you feel about smaller investors entering those emerging areas that seem to be trending upwards?
Look,
I
in
know.
my
I
life,
know it's a tough question. I'm sorry.
I had my own public companies,
Mhm.
and some of them were penny stocks. I know a little bit about that, and
And actually, I heard. This is just a bit of a digression, but I heard that. And correct me if I'm wrong. That when you once had a pizza chain,
what's that?
that you once had a pizza shop. Is that right?
Oh, that was a long time ago.
I
Yes.
know, but you were a
It's
hit.
not a pizza shop, it was a pizza factory. It's
Okay,
a frozen food factory. They were making pizzas, they were doing a lot of other stuff.
but it was in Russia, right?
It was in Poland, in
Oh,
Warsaw.
okay. Well, I'm sorry. I just wanted to bring that out so that our audience, your audience, they already know what a diversified individual you are. But anyway, back to
I did not know that. I did not know that. A pizza shop in Poland.
factory, chicken.
Pizza factory in Poland.
It happened by chance. I was asked if I would be interested to invest, and it was just time. It was almost 30 years ago when Poland just was ready to join European Union, and I thought it's as a country, it was pretty good proposition, and. People were reasonable, and the manager of that thing, he spoke Russian, so it was very easy for me to communicate with him. And I said, okay, I'll go for small investment, and I did. Then I increased that. Then was a time that he had some arguments with some other partners, so I bought them all out, so he could concentrate on operations. It worked very, very well, and then I sold to him my shares, and we're still friends, believe it or not.
Well, I mean, I bring that up because, and I wanted to get to that point. At the time, pizza was unknown in Poland, and so in that regard, it was on the
It
cusp.
was a novelty product,
Right.
yeah.
So, I mean, if I may really mangle and stretch the comparison, and that is to say, you could say that in today's world, it was kind of an emerging food market for you
Yeah,
at the time.
absolutely.
And so, and I was hoping that we could draw on some of your experience there to now explain the thought process to investors now when they start looking at these emerging technology sectors and the green technologies and how they were thinking about it. Because you were essentially in the same position where nobody knew what pizza was in Poland, and here you were, and it was an emerging thing, and the NATO and EU and all that other stuff was still up in the air, and you didn't know, but you somehow had your skills, your thoughts, and your thought process and went into that. Are there any lessons that investors can learn about that from you?
Okay, first of all, you have to put a lot of weight on geopolitical situation of a country where you want to operate. Okay, so at that point, Poland seems to me like a quite promising proposition. And then you have to invest in your investment decision. You have to make sure that the management is up to a skill that they can execute, and they're honest, decent people with managerial skills. Then market for this particular product looked quite good to me at the time, because it's an old story about two shoe salesmen who went to Africa investigate the market, and there were two reports. From one of them was that it's fantastic market, nobody has any shoes, so we can sell as many shoes as we want. Another report says forget about Africa, there is nobody wearing any shoes, nobody needs any shoes there. So who is right? it's hard to say. Looks like both were right, but it's completely opposite the point of view. So you have to evaluate a lot of things. Of course, now about safety on your investment. So I thought that if it comes to wars, okay, there is a structure, there is a machinery, they are producing, already have sales. And I thought that the downside, if it exists, it's not really significant. At least that's what I thought at the time. And there's significant upside, because if they will start increasing the sales. And what good thing is, I noticed that a lot of German, French companies started to open their supermarkets in Poland. So I thought that would be primarily a very good market for these products, because if it's all frozen products, so they can store it and they can sell it, because it had time expiration of 12 months. So there is not such thing as, the product is not good anymore, so we have to throw it out. Because in 1 year, obviously, you will sell almost any product. So I thought that really downside is very limited, if there is one, and upside quite significant. And I thought that it fit all criteria.
Okay. And Sasha, did you have any of those kinds of experiences when you were looking at possibly emerging areas to invest in? And what would your advice be?
Well, today the world is very complicated. It's nothing that it was in 97 as it did this investment. So today the world is very complicated. You have to be very knowledgeable, and you have to be diversified if you can in your investment propositions. Which countries are now eligible for investments? I would still look more for mature markets. For example, if there would be an opportunity to invest in countries like Germany, France, I think United Kingdom is quite promising at this time. Although a lot of people are skeptical because they left European Union, and there are a lot of complications with that. But I think that they will do well, in my opinion. So I would definitely invest there. In markets, developing countries, well, Malaysia, from what we hear from our own representatives there, that looks promising.
Okay.
But I'm not too familiar with this. You have to look at the industries. You have to look at particular situations.
Okay, Shaquille, on this issue of investing in either green technologies or emerging technologies that we know very little of, how would you go about approaching? And what advice would you give?
I don't give advice, but look, I think it really depends on what the investor's looking for. If they're looking at investing in the markets as a potential supplement to their income, then they're probably going to want to stick to more income generating strategies such as options and things like that, as we talked about before. If they're wanting to put some money into something for the long term, then they might look at emerging technologies. But the thing is that, when it comes to emerging technology or green technology, you kind of have to be a bit of an expert in it. Otherwise, you're just taking a bit of pot luck. That's my view. So I personally don't invest very much in the tech sector. I think I've said that on the show before, not because there's anything inherently wrong with tech, just because I'm not an expert enough in tech, right? So I will trade generic strategies over tech, but I tend not to do things like, for example, Snowflake that we were talking about a few weeks ago when it had its IPO. That tends to be something that I don't do because it's just not where I'm at, what I specialize in. And I think when somebody is first starting out, it's best for them to stick to stuff they know rather than going into things that they don't. However, there are probably some people who would like to be behind green technology, for example, and might say, look, I'll just put a few $1,000s into these companies, and that's fine. There's no problem with that, but you don't want to put a large amount of money in, and it's going to affect you negatively if things don't work out. The thing with green technology as well is that technology is improving as we go, and so I've been a little bit reluctant to, for example, there's been some companies that have built solar farms and things like that, and I am a little bit cautious that if solar technology improves dramatically, does that farm then need to go and get a whole heap more solar panels and that sort of stuff in order to be competitive and have a low cost of production? So those are things I think people need to factor in.
I had just a couple of days ago, I had very interesting, just yesterday as a matter of fact, I had very interesting conversation with one individual who lives in Copenhagen in Denmark, and we discussed several things, anywhere from business to chess to just investments, election, in U.S. And I asked his opinion, what he thinks about this, and he said that I really hope I would really vote for Biden because there are more chances that U.S. would rejoin the Paris Accord because this is a very, very important concept. And then he told me incredible thing that in Denmark they satisfy all their energy needs from solar energy. And I remember now that once I was last time in Copenhagen about 4 years ago. I had a friend of mine who lives in Copenhagen, and I've noticed abundance almost everywhere you look. They have all these solar turbines, and I asked my friend at the time, why do we need so many of those? He says, that's our energy source. We don't need oil. We don't need all these products. We are very happy with the clean, inexpensive energy. And I was quite fascinated by that incredibly enough, instead of using coal, oil, and all other stuff, they're using just the solar energy. Isn't it quite interesting?
I think it's great to see like countries like Norway and Finland, but especially Norway, they rely so much more on hydropower. And I'm actually quite a fan of hydro and geothermal. I think that they're probably better solutions than solar and wind. But the thing with hydropower and with geothermal power is that it is a lot more consistent, and so they can actually build some quite large power stations. And when you're investing in a company that's going to build one of those things, they know what their throughput's going to be, what their output's going to be, approximately their cost of production, and what price they're likely to get for those units. And so those are relatively safe investments. Utility companies tend to be a yield play for most people, so people sort of treat them almost like they're a bond because the revenues are normally relatively stable. The amount of electricity being used by a community or by a city is generally fairly stable unless something major happens to the economy of that country or we have COVID or something and some businesses have to shut down. But outside of those sorts of things, it's generally a pretty standard, pretty stable and predictable cash flow stream.
Very, very interesting. So this is Bill. That probably covers your questions about renewable energy, the sort of green aspects, green world, new green world. Yeah, that's kind of interesting.
But I did have just a small, just curious question. How many different kinds of pizzas did you manufacture?
Probably. Well, you see, there are had probably up to 10 varieties, but also they vary by size. They're like small, medium.
Oh, okay.
Average. And there are also different, also frozen products like lasagna, like some other stuff. So altogether, there were probably close to 50 different items.
Okay.
The real question is, how many times did you actually go home and cook? And how many times did you just pick something from the factory and take that home for dinner?
Yeah, there was. It was quite an interesting story in my life. I traveled a lot at the time to Poland. I've been in Russia many, many times, but this concept in Russia was way much more difficult to organize because of the corruption issues, and everybody wanted to make their money even before factory would be built. Money right away, up front, and so on. So it's not a good investment environment, I would say.
So with 20 some odd days left, Sasha, what are you thinking over the next 3 weeks, given the election? How are you looking at the stock market?
I think the stock market will continue to go up and up to the election day. And so far it's happening that way. However, after election, there are 3 results. Biden wins, Trump wins, and contested election, which will go probably all the way to Supreme Court, and we know all that. And if Trump will win, then the market most likely will continue to go higher. If Biden will win, market probably will go lower. and it will go much lower in case of contested election.
Mhm.
What do you think, Shaquille?
That's about what I think at the moment. Um, I'm actually quite reluctant to even make a prediction as to what the market's going to do, because when Trump looked like when Trump had COVID, the sort of market reaction, everyone was saying, well, look, is he going to be out of campaign, and this sort of stuff. And what you saw was the note prices dropped, and so yields went up on the 10-year note futures, which was interesting. And I was having a look at the reports at the time, and it was about, basically, this is it. Donald Trump's there's no way he can possibly win. And then now that he's come back out on the campaign trail, the note prices have gone up, which means yields have gone down again. But note prices normally have an inverse relationship to the market. So you've actually seen the market go up as well. And this has been a big concern, I think, for a lot of professional traders, is when you're seeing things that are normally negatively correlated all move in unison together, it's very hard to predict and work out what's going to happen. And I think that the political impact on the markets is going to be still somewhat overshadowed by what's going to happen with COVID. So just for example, if on November the 2nd, there was a vaccine released and there was no risk and it was absolutely perfect, although that's not likely to happen, but just as a hypothetical, right? And COVID is just totally cured and nobody has to worry about it again. That, I think, would have a much more pronounced impact on the market than even what the election would. So having an election in this climate, I think it just makes it very hard to really predict with any sense of certainty, what's going to happen and where it's going to go. Also, generally speaking, whether it's an incumbent president or a new president, the market tends to drop just a little bit after an election, and then it kind of settles between it sort of settles closer to the inauguration date, because then it becomes a little bit more clear as to what the new president or the incumbent is going to do. So I think it's just really hard to guess that. But I think that the place that I'd be looking at is keeping a real good eye on interest rates and seeing how government debt is doing, because that's going to determine where the flow of money is going to go internationally and where the flow of money is going to go with all the institutions. I think that'll be an important place to watch.
Okay, so here's, I want to just, again, I'm not trying to give any recommendations at this point to anybody. I'm just trying to share with you what, at least how I'm approaching this trading environment. What I'm trying to do is, first of all, in this situation, one of my investments is in a gold company, as you would probably expect it. Yeah, I have 1,000 shares of Kirkland Lake. It's a Canadian gold company, and the stock is doing nicely. I'm sitting on a good profit, but again, as a protection, just in case, and also as a cash generating idea, I sold the covered calls. Which will generate additional, most likely $5,500 on my position, and they will expire on January 15th. So I'm sitting on this position. Of course, I have also options on TZA. It's remember I told you about it. It's a triple bear on Russell 2000, and I have it both ways. I have a lot of contracts. I wish I wouldn't have so many, but I do have a lot of contracts. What I did, I sold 20 puts and I sold 21 calls. So it's kind of a almost neutral trade, except that because I wanted to consolidate my winnings on a call side. So I had January expiration, so I cashed that. And I sold now March. Is it March or April? No, it's April 21 calls. So I sold plenty of those calls, and I'm sitting on puts, which I sold as well. So the beauty actually of this strategy, which I'm using for many other stocks, the beauty is that you're not doing, okay, let's say a day goes by. You don't do any trades, nothing. Your bank accounts increases a couple $1,000 here and there, just doing nothing because the time expiration. So these options are becoming what I sold, becoming cheaper and cheaper and cheaper. So the stock goes back and forth. It fluctuates a little bit here or there, or it's going higher, and you see gains on your account even if you don't trade. Uh, and therefore, I'm doing very little trading. I'm just doing adjustments. For example, if one of the options is doing very well, I cash in and just sell another further expiration months. For example, I recently initiated, I sold puts on Goldman Sachs, which is doing quite well now. And I sold this October 16th, which is 2 days from now, expiration. I sold 212 and a half puts, and now they're out of the money. At that time when I did it, they were in the money, so I got a lot of premium coming in, and now I will cash in probably tomorrow, and will sell probably January, maybe even not 12 and a half, maybe 215 puts. I'm sort of debating this. So I actually, as the shares are concerned, I have very few shares in my account. I have Kirkland Lake Gold. I have still Altria, which pays dividends about 8%. And I have Nvidia. That's it. I have 3 positions. Now, in options, I have many more positions than that. Actually, I sold also I sold puts on a company NIO. NIO, it's a Chinese company which is working on electric cars. Their shares are doing quite well, and I think I will do probably the same thing what I've done with Goldman Sachs. And of course, I have TZA as my protection. So if the market will going down 5,000 points in a Dow or so, then my TZA will perform very nicely and will cover whatever else I have. So I have significant positions in TZA.
Okay. Listen, if investors start to get nervous in the upcoming weeks, what would you either of you recommend as kind of safe places to go and weather and hang out and sit?
So I'm normally loath to give this answer, but I'm going to give it anyway.
Okay.
There's nothing wrong with just take your money off the table and sit it out. Right? There's nothing that forces you to have your money in the market. That's the first thing I'll say. The second thing I'll say is you shouldn't be getting nervous in 2 weeks from now. You should already know today what you're going to do. My positions, for example, I've covered most of the things that I'm doing, and I've done that over the last month or so. So I know exactly what my risks are going to be given any outcome, not off the election, but any outcome in the market, whether the market goes up significantly or goes down significantly. I get a little bit hurt when the market doesn't do very much because I'm a volatility-based trader, but I'm only getting a little bit hurt, and that's okay. The market will eventually make a move. So that's how I personally trade. Now, I understand that most of the audience is not going to be as advanced as me, but whatever you're planning on doing, you should have that plan now well in advance, because it's not like it's a surprise. We know the election is going to be coming up, right? It's not a surprise. So, let's plan for that. Obviously, COVID was less obvious to most of us, I think. We started hearing about COVID back in sort of November, December of last year, but we didn't really, well, certainly for me, you'd sort of heard about this thing that was happening in China. It was like, it's not really a big deal. It's so far away from us. It's not, and the next thing you know, it's sort of beginning to creep into a few other countries, and then it sort of became this big thing as we know it. Really around February was when it really became a big deal. So those things can take people by surprise, but the election doesn't. So there isn't really an excuse for not having a plan for that.
I remember February very well because I just came back from 3 weeks holiday in Latin America. I was on a cruise ship, very nice trip. We covered Argentina, Brazil, and Uruguay. And I came back to Toronto on 2nd of March, right before coronavirus started, and then was a market fall and so on. I managed through all that quite nicely, except one stock. I got a hit on Boeing. Because I thought and I had only 200 shares, and yet I had to take a loss on that one simply because I thought that all bad news about Boeing 737, everything was already out. So from this point on, it cannot go much lower, and I sold juicy covered calls and got a lot of premiums. But even that didn't help me because Boeing was like going down like a rock, and I had
to I haven't actually looked at them for a while, and I really should. But it'd be interesting to see how Boeing, Airbus, and actually Lockheed Martin, how those three have actually done, because there's actually been a huge increase in purchases of private jets, and now's a pretty good opportunity if you're a small startup airline. A lot of the time they're having to either dry lease or sometimes wet lease the aircraft off bigger carriers. And this is probably a good time to maybe look at buying your own planes if you're a small startup. So it'd be interesting to see how their share prices held up. Because you tend to find with the airline industry, passenger jets and the passenger airlines really struggle no matter what the market's doing. But everybody else in aviation makes a lot of money. So
that's right. Yeah. Agree. So if some people are thinking about starting new airline, I think that's the time to do it. Not right away, but by the time that you will organize it and put everything in place, and finances and planes and so on, and to start airline maybe sometimes mid next year, I think these people could do quite well.
Okay.
Like Air, it sort of has a ring to it. Do an IPO out of California and be fine.
Yeah, that's right.
That's great. So yeah, we are at about the 9-minute mark, gentlemen. So I guess to ease everybody into the rest of their Wednesday or into the evening, since we are international, what thoughts do you have that you might want to pass on?
Well, I'll just say, coming into the election, I know a lot of people are obviously taking more of a position the closer and closer it becomes. And I would just caution people off trading the market, assuming that what they think is going to happen is actually going to happen. There's always surprises in politics. There's always all sorts of things that go on, and I think the politicians like to do that. So that would probably be the thing that I would say. Be very, very cautious about thinking, one candidate or one party is going to win, and that's the only possible result. And I'm going to trade the market in a certain way with that result in mind, because you may not get the result you want, or you may actually get the result that you think is going to happen, but the market may react way differently to what you're thinking. So I think that, that would be my advice, is pay attention to risk, and risk. Whether that be, for me as a professional investor, I've got risk guys that will come up to me and give me a hard time. That's what I pay them to do, is to give me a hard time when I'm overweighted on something or when I'm taking on too much risk. And, I wish that I could go back. I mean, I've learned a lot of lessons and they're worth me learning the lessons, but I have blown up my personal account more times than I care to remember. But, when you're in your early 20s, it's okay. You can survive it. You can come back, and blowing up your personal account when you've only got 5,000, and it isn't so bad when you're in your early 20s. Obviously now it would hurt a lot more. So, you have to learn those lessons. But the one thing I would say is, look, especially if you're a bit older and coming into the market, you can't really afford to take too much risk. Pay attention to your risk first before you pay attention to what your potential return is. Have a look at risk first. If you can't survive that risk, then don't do the trade.
Shaquille, you are very eloquent, and I agree with all your suggestions. The idea of taking money off the table is there is a lot of wisdom in that, and I'll tell you why. Because historically, if there are market swings, it tends to go in percentage points down way more than it would go higher. Let's see let's see even, okay, Trump probably will be reelected. So in this case scenario, probably market will go higher, 10% maybe, 15. But if market will go down, especially in case of contested elections and fights and going to courts or so on, market can go down easily 20, 25, if not 40%. So your risk-reward ratio in this situation is heavily into being as much in cash as possible. In my individual account, well, okay, with gold shares, I don't think there is a lot of risk. They may, if anything, they may go just higher if any turmoil or so on. And well, what else I have? Nvidia. I have this Altria Group, which pays 8% dividends. I don't see much danger to hold the stocks. But other than that, I'm not buying any shares for a long time now, and just trading options here and there. So I think I will stay the course in what I'm doing, but I have to be extra careful. And if before I could check market once, twice a day, maybe now I will check it 3-4 times a day, maybe more.
Okay, and so then I guess for you, Sasha, you really aren't going to pay too much attention to the economic news coming out of the third and fourth quarter then this year, right? Because you'll be staying out of the market for the most part.
Well, I'm paying a lot of attention to the news, especially, for example, if I have options on Goldman Sachs. Of course, I'm very interested what are the reports. Report was very positive, I think, yesterday. And so reports are coming in, actually, as we speak. Almost every day you have new reports or so on. The reports, for most part, are quite encouraging. So I really don't see how the market could go much lower before election. After election, it's anybody's guess what's going to happen. That's my opinion.
And actually, Shaquille, if it's anybody's guess, isn't that where you thrive in the volatility of the market?
Yeah, normally, but the market isn't really swinging the way that I would ordinarily expect. So what I've done, it's not a problem. I'm still making money. But I'm having to trade the market just a little bit differently. But I also have to account for, like, the things that I go through my mind. What I'm thinking about is, okay, if I'm having to change what I'm doing, and I know that I often say to people that I'm a trader, but I'm not. I'm a strategist. So because of that, I've got a lot more perhaps experience and the ability to change up different strategies and apply different strategies at different times. But a lot of professional traders don't do that or can't do that because of regulations and rules off their fund. So that means that I've got to try and take into account not just what I think is a good way to trade the market, but what restrictions other people have and what the institutional flows of money are likely to be given the circumstances. But look, I think that's way outside the scope of what most people who are starting out want to know. As I said, I actually do think, I know Sasha has said that people don't normally start with this, but I actually think that spread trades with options is a good idea because you know exactly what your risk is, you know exactly what your potential return is, and you can kind of start to have a bit of a play with it. And so if you do agree with what Sasha said, the market is likely to maybe go up a little bit or trend or just drift upwards or drift sideways, spread trades are a pretty good way of making some profit out of that.
Yeah, I think you're absolutely right. It's very interesting, really, what's happening on election day, which is not too far from now. I'm following this betting site, Bet365, which are providing actual odds on both Biden and Trump. And odds, as we speak, odds on Biden to win election is 1.5 and on Trump 2.7. So so you can make actually some pretty good money on the election result. Let's see, you can invest $100,000 on Biden and get half of it as a winnings. On Trump, better.
The odds have actually moved a lot because before it was a little bit closer. I think Trump was around the $2.20 mark. He briefly hit around $1.90. I'm referring to Betfair prices. And then after COVID, after he had that COVID scare, it went all the way up. I think it was up at like $3.10 at one point. And it's come back down to sort of that 270, 260 range now. So, I mean, even the betting markets, you know, the odds are just going all over the place. It's very hard, I think, for anyone to tell what's happening.
It's very interesting. Yeah, so the markets are there today, tomorrow, next week, next month, next year. So don't rush. The market is always there. There are always opportunities. You don't have to do something right away, right now, next hour. You can do it tomorrow. You can do it after election, maybe, when things will be more clearer. And I would like to thank you so much for being on the show and having very nice and hopefully profitable discussions. And I will see you again next week. And I want to say, everybody, how you say, good night,
good morning.
Day, good morning. Depends where you are. And ibmtv Investments, just Sasha. Thank you so much again.
Okay.
Bye-bye.
Bye.